Ladies and gentlemen, I have some new critical information to share with you and some new charts to share with you. And when I saw these charts, I said to myself, the banks are preparing for something right now. And what the data in these charts are telling me is the only thing the banks could be preparing for is a cataclysmic black swan event. Because we have some new massive warnings that are happening in the markets right now and many people aren't seeing it. But everyone, I'm going to decode all of this for you in this video, and this will be one of the most important videos I do to date. So let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Okay, now before I get into these critical charts, we need to paint the picture of what's going on right now. So first things first, Jamie Dimon warns souring commercial real estate loans could threaten some banks. So okay, we know the banks have been collapsing lately, but there's going to be more banks collapsing. So keep this in mind before I get into this new chart and this new data on what the banks are doing. There's always an offside, Dimon said in a question and answer session during his bank's investor conference. The offsides in the case will probably be real estate. It'll be certain locations, certain office spaces, certain construction loans. It could be very isolated. It won't be every bank. So of course, this is old news, everyone. I've been warning about the commercial real estate market and the risk it has for the financial system for months, well ahead of the mainstream media, but this is something we have to watch because the situation is getting worse. So he says commercial buildings in some markets, including tech-centric San Francisco, may take a hit as remote workers are reluctant to return to the office. And that's exactly right, everyone. I did the video on how the office building in San Francisco dropped 73% in value, but this is just the tip of the iceberg. Now, another risk, everybody, is the credit cycle. There will be a credit cycle. My view is it will be very normal with the exception of real estate, Dimon said. So again, something else I've been warning about. I've been warning about there's going to be a credit freeze, a credit crunch. It's already happening now. Banks are tightening up their books because they don't have much money left to lend out. But again, that's not the worst of it. For example, if unemployment rises sharply, credit card losses might surge to 6 or 7%, but this will still be lower than the 10% experienced through the 2008 crisis. Oh, and would you look at that? As I'm recording this video, breaking news, Lowe's cuts full year sale forecast as spending on do-it-yourself projects weaken. So that's another thing that's going to hit the banks very, very hard, everyone. A surge in credit card losses. A lot of people are spending like crazy just to survive on their credit cards, but eventually their credit cards are going to get maxed out, and then they're going to have nowhere else to go, and they're going to default on these loans. And like that breaking news just popped up as I was doing this video, this is going to crush demand, and it's going to lead to more layoffs. Like he said, once that unemployment rate starts really rising, we're going to see more defaults. Separately, Dimon said banks, especially the smaller ones most affected by industry recent turmoil, need a plan for interest rates rising far higher than most expect. So that's another thing, everyone. We have the markets in a speculative frenzy right now. They all think when the Federal Reserve pauses this month in June, that's it. There's not going to be any more rate increases this year, and they actually think there's going to be 3 rate cuts. But what if that doesn't happen? What if interest rates go to 6 or 7%? The markets aren't prepared for this, and also the banks aren't prepared for this. Because the whole reason these banks are in this issue in the first place is because of interest rates going up, causing these bonds, mortgage-backed securities, commercial mortgage-backed securities to plummet in value. Because why would you buy one of them that's paying 2 or 3% when you could get one that's paying 5 or 6%? Now, again, they think the worst is over, but if there's more rate hikes coming, there's going to be much more pain. And in the shadows, the banks are preparing for this. And again, that chart I'll go over in a moment, I haven't seen anybody cover. So the Fed concluded last month mismanagement of interest rate risk contributed to the failure of Silicon Valley Bank earlier this year. And he said you're already seeing credit conditions tighten up because the easiest way for a bank to retain capital is to not make the next loan. So what do you think is going to happen if interest rates spike? We see mass defaults in the commercial real estate sector. We see mass defaults with credit cards, and consumer demand collapses. That's right, the stock market is next. And market guru Larry McDonald warns the S&P 500 will crash 30% by December as spending slumps, profits shrink, and banking problems mount. But okay, I'm not going to make you wait any longer. What you're wanting to know is, what are the banks in the shadows preparing for? Well, look at this chart, everyone. So this is a chart of credit default swaps. This is insurance banks buy in case, for example, bonds or, for example, treasuries, the government bonds, treasuries, commercial-backed securities, mortgage-backed securities. In case of default, this is the insurance you buy. And look at this chart, everybody. It is absolutely catapulting into the stratosphere. And we have not seen levels like this since 2008. Again, I haven't seen any news article whatsoever or anyone in the mainstream media or YouTube covering this. But this tells us silently in the background the banks are preparing and preparing big. They know something is about to fail, and also we're getting recent moves in the bond market to say these bond investors are very, very worried. So look at this, everyone. This is a 10-year US Treasury, and we can see it absolutely spiked today. It's gone up to a high of 3.75%. This is around 45 basis points or 0.45%, which is a big move from the bond market just in the past couple of months. But let's have a pause there and let's have a look at these reasons why the stock market could crash 30% by December. So the reason why he's saying the market is going to crash, and I completely agree with him here, is a triple whammy. There is shrinking corporate profits, which is like what we just saw with Lowe's at breaking news, less government spending, the government's bankrupt, they're having to take on more and more debt, they can barely take on the debt as it is, so there's going to be way less government spending, especially compared to 2020 and 2021 with all the stimulus checks, and fractures in the financial system that would deal a staggering blow to stocks. Well, we're seeing that as well. We're seeing banks collapse, we're seeing huge issues commercial real estate sector, we're seeing a credit crunch, we're going to see credit card defaults skyrocket. And again, in the shadows, the banks are not telling you this, they're buying insurance for the big event. For example, McDonald's signaled out a nearly 30% drop in MetLife stock this year and noted large insurers don't usually lag the market by a huge amount unless something very big is happening. So this is very interesting, everyone. In the shadows, the banks are buying this insurance and these insurance company stocks are crashing. Does that tell you some insiders know there's going to be a big event which will lead to some of these insurers going bust, just like in 2008 with AIG? He suggested the decline reflects concerns about the company's vast commercial real estate portfolio, which has likely come under pressure from high interest rates and tighter credit. So I think it is very, very likely that we're going to see these commercial mortgage-backed securities completely blow up the financial system. And that may even flow into the treasury and the bond market. But again, that's not the only risk right now. He asserted that the post-pandemic government spending has helped to stave off a recession, but Republicans could soon force a Biden administration to rein in its spending in exchange for raising the debt ceiling. Well, I think that's highly likely. He said this is going to let a lot of air out of the stock market bubble, and the only reason that's been supporting this bubble is huge government spending. But have a look at another chart here, everyone. These valuations have never been this high since 1999 and 2007. So this is the S&P 500 price to earnings ratio. Again, right now it's 24.27. The mean is 16.01 and the medium is 14.9. So we are at least 30% overvalued. And again, the only time it's gone above this level is in 1999 and 2008. Just to validate this, the Warren Buffett indicator, the man himself, the stock market right now is 167% of GDP and it is overvalued. So he's bang on the money there as well. He also made the case that stock valuations should recede given the current financial turmoil. Several banks have collapsed or have been rescued by bigger rivals in recent weeks, stoking concerns that lenders might pull back to protect themselves from bank runs and inadvertently cause a credit crunch. So you're starting to get the picture here, people. The fundamentals don't add up. These stock valuations have no support. They have no foundation, and economic reality is about to hit the markets and hit them hard. Moreover, American consumers and businesses are feeling the squeeze from historic inflation and high interest rates, which is putting pressure on asset prices and threatening to drag the economy into a recession. Well, I think we all know we're already in one. The prospect of less spending and investment, stricter lending, steeper debt payments, and greater unemployment bodes poorly for corporate profits and stock prices. He's bang on the money here as well. We're in a recession right now, inflation's destroying the consumer, there's high interest rates, unemployment's about to go up. There is no reason why these stock valuations should be so high. But there is one more very important indicator, and we have not seen this happen since the Great Depression. That is the M2 money supply. We can see in here it's gone nowhere but up since the 1960s and also the Great Depression, but this chart only goes back to 1960s. But we can see here for the first time we are seeing the biggest contraction in money supply on record. And the only reason this market hasn't crashed has been from all the stimulus and all the money printing. But now that's being sucked out of the banking system, it's being sucked out of the economy, and we're going to see economic destruction. Again, people, I'm not trying to be a fear monger, I'm just trying to tell you the truth, but maybe you can handle the truth. So okay, you're probably wondering, well, what can you do to protect yourself? Well, McDonald, he tells you some things he thinks you can do, and I completely agree with him. So we caution against owning main US stock indices as they're too exposed to high-flying tech stocks. That's exactly right. Instead, he recommends beating down cyclical stocks in sectors such as energy and hard assets such as gold and silver and platinum. Well, me, I'm not an expert on platinum, but I do think if we do have a real cataclysmic economic event, gold and silver will skyrocket. People will run to a flight of safety, a real hard asset, and that is gold and silver. Now, one final thought why the banks could be buying these credit default swaps and why the bond market yields are surging right now. Maybe the banks are preparing for the most unthinkable event that would happen is a US government default. And people, if that does happen, the last thing you'll be thinking about your stock portfolio, because things would get crazy in the streets very, very quick. But I do think that is highly unlikely, and a much more likely scenario I think that's going to happen is a commercial real estate sector coming down and more bank failures. But everyone, what do you think about this? Let me know down below. Now, if you've liked this video, check out my free newsletter where I go in depth into these reports and also give you my research and notes in case anything happens to me on YouTube. Thanks for watching. I'll see you all in the next video.